Hello, everyone. So today we're going to look into deal analysis, and Paul, you've looked into over 3,000 deals, so that's a massive number of deals. What surprised you most about why the majority haven't actually gone through?
Yeah, so look, it's not difficult to do deals, but there is a process that we've certainly refined over the past 15 years that works if put into play. And I guess the reason why, if I look back at those sort of 3,000 opportunities that we've looked at, obviously we've done. I think 107 transactions now. So some people might say, well, that's a really poor conversion rate, 107 deals out of 3,000 opportunities. But, it is a numbers game. And if you look at the reasons why the others didn't progress, I guess there is a common theme across them as to why. And generally, it's around sourcing the opportunity and the conversations that you have with the business owners and educating them on the whole M&A process to I guess, get them to understand how we operate as a buyer. And look, sometimes there are things outside of your control as well that happen, life changes, etc., that, can put a kibosh on a deal. But yeah, it is very much a defined process that if applied, it clearly works because we've done 107 deals over the past sort of 15 years or so.
Okay. So when you went deep into those 3,000 deals, what were the most common red flags or deal breakers that kept them from, I suppose, actually closing and getting them over the line?
Yeah, so most of the deals that we do with partners. So like-minded entrepreneurs, business owners that want to either scale a business or want to get into the world of business by making an acquisition. I think it's a much easier journey. And whilst I've done startups in the past and they're very fun, startups don't have cash flow, they don't have a brand, they don't have people, they don't have processes, and you've got to create all of those things. Where if you buy an already established profitable business, then it comes with all of those things, and then we can apply our expertise to, hopefully grow it. So when we're working with partners, it's very much about sharing our process, our resources, our people, and then deploying them into a particular industry sector or niche, and then really applying the buy, build, sell model. So find a platform company, then make tactical strategic acquisitions to build a larger group, and then hopefully once we've built it, we can create a successful exit. But what we find with a lot of people particularly when they're starting out in this journey, is they tend to go to brokers, and if people watch this podcast, I know there are some good brokers out there, but in the main, brokers or middlemen, if you like, are people that charge a fee for providing a service. And when there are fees involved, there tends to be, inflated valuations. They can be deal blockers. They make more probably on their upfront fees and sort of monthly retainers than they do on, actually creating successful transactions. So it might seem a bit counterintuitive to say, well, look, there's a broker here, they've got 50 businesses for sale. That gives me 50 opportunities. I don't have to do any of my own sourcing. I can go and have conversations with all those 50 if I really wanted to. But unless you're working with a really strong broker, you're just going to get into difficulties. Brokers will ask you for proof of funds, and if you're funding it through a leveraged buyout, you're not able to provide that because you have to do your due diligence and your financial modelling and your business planning before you go and talk to the banks, and you can't do that until you engage with that opportunity. So yeah, brokers. I think out of the 107 deals we've done, three of them were with brokers, and I would say that they were all probably the most difficult deals to get over the line, and also we definitely overpaid for those three. So while sourcing might seem a very laborious, time-consuming process, ultimately, if applied, you can get direct to seller, opportunities where there isn't a broker involved, and then your job is to educate, build a relationship, and ultimately try and convince that business owner that you're the person that they should sell their business to, and they have a understanding of how that transaction is going to work. Whereas if you go and find a deal through a broker, you've got to probably undo a lot of that thinking, because they probably think you've got this magic pot of money and to deploy into the deal, that you'll pay a much higher price because they valued the business at a certain level. Whereas if you go to a seller that hasn't got any experience whatsoever of M&A, they've not sold a business before, but there is maybe a pressing need for them to sell. Maybe it's health reasons, maybe it's retirement, whatever. Your job then is to engage with them and be that educator to ultimately try and get a deal put together that works. So I'd say stay away from brokers, and that's absolutely a red flag. We now don't work with any sort of partner where we're sourcing opportunities through brokers. It's just a complete and utter waste of time, and that's from 15 years of experience of doing this, and nobody's proved me wrong otherwise. I think the other thing as well is that there's a lot of time and effort that goes into putting these deals together, so it needs to be worthwhile. So typically when we're sourcing opportunities, we're looking for a minimum EBITDA figure, typically 750k, so that's in sterling, so it's around about $1 million US. That's the sort of minimum EBITDA that we'll transact. So there's a few reasons. Number one, it's worthwhile if we actually get the deal done. The more profit there is, then the bigger the deal, the bigger the opportunity. There are quite a lot of costs associated with raising funding to do these types of deals. Particularly if you're not putting any of your own money into a transaction, then the sort of lenders that you can borrow from will see the risk, and they will also see that you haven't got any skin in the game, and for that they will charge a lot more than maybe a tier one bank would. So having that minimum EBITDA helps with that process. But then probably more importantly is when you actually own the business. If it's chucking out 1 or 2 million a year in profits, then it's probably not just reliant on the business owner. There's probably a team behind the business owner, a capable management team, that whether the owner's there or not, the business will consistently perform. So yeah, having higher profits is quite important. I've obviously just mentioned their capable management team. We would never buy a business where there isn't a capable management team in place. Why would you pay the star employee, the owner, to leave? And when they leave, all of that many years of goodwill, relationships with customers, relationships with staff, that know-how, that expertise, that contact base just walks out the door. So it's really important that the business has a capable management team in place. And we actually like to buy boring, consistent businesses. If every year it chucks out 1.2 million in profits year in, year out without fail, that is a stronger acquisition opportunity for us than something that either is on a bit of a growth spurt because it's probably going to need a lot of capital to be able to maintain that, or if a business is declining, maybe it's lost a customer, a contract, or something like that, then that again would be a bit of a red flag for us. If we're going to fund these deals using debt, then it's really, really important that we have a consistent, profitable business with a capable management team that's going to continue that and hopefully grow it under our ownership. To make those deals work. And then the final thing is they need to have a balance sheet that is very strong. It's probably cash rich. It's probably got assets. They don't have to be hard assets like plant machinery in an industrial business, but invoice receivables could be sizable in a sort of B2B service type company. So sometimes you have to look beyond the sort of traditional fixed assets, but yeah, they need to have a strong balance sheet. If we're going to inject debt into a business to fund a deal, if there's going to be some form of seller financing, then it needs to have the right financial profile. So I suppose to summarize it, stay away from brokers, make it worth your while by looking for those consistently profitable, larger profit type businesses that come with a capable management team, and consistency and financial profile is absolutely key. So if I go and look back through all of those 3,000 deals that didn't happen, the common theme really will be one or a multiple of those things as to why those majority didn't progress. And if you look at the 107 that we have done, they bar the 3 that we did with the broker probably 4 or 5 years ago, they all fit that profile.
Okay, so just talking about management team. So would you walk away from a deal that does have a solid management team in place?
Yeah, I mean, we want to buy a business that comes with a capable management team. So that's a big tick from our perspective. But if the business didn't have that, then it would be very, very much high risk. So have we bought businesses in the past where we haven't had that capable management team? Yes, but that's generally been because we've had already got businesses that we own in that particular space that already has that capable management within it. So plugging in a business that, after the owner's done a handover, we've already got that expertise, knowledge, and contacts, then we could maybe make that as a tactical acquisition. But if we were getting into a brand new industry that we've not been in before, and we didn't own anything in that particular industry, if there isn't that capable management team, it's better to walk away. Sometimes people say, well, it's quite easy to go and recruit somebody. So let's say I buy an engineering business. I'm not an engineer. I don't have any. I've done deals in engineering space, but I'm certainly not an engineer. Could I go out and find the best engineer in that particular sub niche? Could I go and recruit them, encourage them to come and work for me, maybe entice them with some sort of shareholding in the opportunity? Yes, of course I could. But the thing is that you can go and find the best person in that industry, but they don't necessarily have the same relationships with the staff, with the customers, with the suppliers, and you can't underrepresent that level of goodwill. They might have the industry experience, they might know what processes need to be deployed into a business to grow it and improve it, but they don't necessarily have those relationships. If a business owner's been around for many years, built a team up, got those relationships, then leveraging that is very, very important. Bringing somebody in completely from outside, whilst we've done that before, generally they've not been as successful as the ones that already have those key people already in situ.
So if you had a business that it's got a solid management team, let's say it makes £1 million profit a year, but that profit is derived mainly through 2 or 3 key clients, is that suddenly a very risky business to enter? Would you enter it, or would you see that as potentially more red flags?
Yeah, I mean, when there's a high customer concentration, it's always a big risk. One of the businesses that we were involved in quite some time ago was a blue chip, Fortune 500 company was the main client. It derived around about 85% of the revenues for this business. And after we'd acquired it, despite us, most people think, well, that's good. They're a blue chip company. They're very financially secure. There's not going to be any risk of them, suddenly not paying their bills. But the real risk comes in, if there's a change in that business, or if there's, in that particular industry, there was a regulatory change, which after we acquired it meant that they basically didn't spend as much money, and profits halved in that particular business. So, if you're basing a deal on using debt and you need the cash flow to be able to service that debt. Well, if you lose a customer contract or customer declines, then effectively there's no business or there's not enough cash flow to then service the debt. So, there is that to consider. So I looked at a transportation business actually last week with one of our partners where 90% of the revenues came from one customer. Now, the seller's argument was, well, I've been doing business with this customer for 20 years. It's rock solid. We have the relationship. They can't basically do business without us. But, we walked away from that deal because it would just be far too high risk. Would we buy a business with high customer concentration? Yes, but we would certainly never fund it with any form of debt. It would probably be more on a joint venture, or maybe we take a stake in the business to, loop it into something that we've already got. And maybe then there's some upside for the seller later down the track if that then is maintained. But we would certainly not take the risk, in a high customer concentration business with debt for sure.
Okay, so taking into account all these, I suppose, parameters of how you look to do things, how do you actually find the deals that are worth your time, and what is the screening process like?
Yeah, so I mean, ultimately, it boils down to a few things. Number one is relationship with the seller, both through educating them on what we're going to do, how we put deals together, why we do it that way. Them trusting that we're going to be a good buyer that's not going to wreck their business that they've spent many years building. We're actually going to do something with it, build it, grow it, build upon their legacy. That is quite an important side of things. I would definitely say. The second thing is then the process that we follow. There's various stages of the process. First, we've got to source the deal. We've then got to engage with the business owner and build that relationship. Once we then get some financials, we've then got to analyze the deal and then make some sort of financial proposal. We've then got to negotiate. Maybe there's some objections along the way that we need to overcome. And then once we've actually agreed a deal and maybe signed a term sheet, there's the whole process of due diligence, raising the money, the legal process, and all of that takes time. And I guess what we've learned over the past 15 years of working with other people is that there are key parts of that process that if you just think, oh, do you know what, I'm going to save a bit of time, I'm not going to do that, you risk basically the deal falling through. So it's really important that every part of the process is followed to the letter. It might seem a bit rigid, but if it's followed, it works. If it isn't followed, then you're basically setting yourself up to fail, and you're going to waste a lot of time and effort in the whole process. So yeah, for me, they would be really the most important things. And I guess when we work with other people, we've got 15 years experience, including when things haven't worked. And I think sometimes when things haven't worked, you actually hopefully you learn from that and don't repeat that a second time. So we have that 15 years of experience that we can deploy when we're working with other people, that you can benefit from that expertise.
If you're interested in mergers and acquisitions, we have a free to join community of deal makers around the world where we share knowledge, expertise, deals, and joint ventures. I produce regular content there, and it's the first place that you can see it. So if you'd like to find out more about this and how we can joint venture together, I guess the vast majority of deals that we have done have been with joint venture partners. And I guess to get to 100 plus deals, there's only so many hours in the day. So by sharing the work with like-minded others, we can increase that bandwidth. So to learn more about this and to join our community, visit buybuildsellprogram.com.
Okay, so there seems to be two types of people in M&A. You've got people that are very prolific in doing deals, and then you've got people that, even 2, 3, 4, 5 years into a process still haven't managed to do a deal. What is it that sort of separates deal makers from dreamers, I suppose?
Yeah, so I mean, I think the biggest thing for people is perseverance and tenacity. This is a sales process. You've got to market yourself firstly to find the deal, so you've got to do some sourcing to find the opportunity, and then it's a sales process of convincing that business owner to make it, make the deal work. And given that they probably own a successful, profitable business and have done for many years, most business owners are going to be fairly adept at negotiation. So, you need to be a strong negotiator. But the biggest thing for me is, there's two things really. Number one is action takers. There's a lot of work that has to be done to get the deal done. You've got to find it, you've got to put it together, you've got to negotiate, you've got to sign it off. And if you were starting completely from scratch and had absolutely no deal flow whatsoever, it's probably going to take you a good 9 to 12 months of working this process day in, day out before you get that first deal over the line. So sometimes people get a bit fed up with that. Sometimes people think that maybe we could do it, cut corners and be more efficient and use different tools and stuff to try and cut out the time. And we've proven over the years that it doesn't work. There is a process. If you follow it, it works. If you start cutting corners, you start leaving things out, you start doing something different, that's when you risk things not happening. So people can get a bit worn down by the process. It's not for everyone. You have to be incredibly persistent, persevere, and have a lot of tenacity. If you look at that opportunity, what we started talking today about what we learned about the 3,000 deals that we've looked at that haven't happened. Well, you've got to be incredibly tenacious to go and have 3,000 conversations and hear the word no, and I want more money for the business, I want more upfront, I don't like the way you're funding the deal, whatever the objection is, you've got to have lots and lots of conversations that won't go positively before you find that deal. So the people that we've worked with that have been successful, that have been the most prolific, are the people that will take action, follow the process, and will persevere, and won't give up and throw the towel in halfway through.
So have you had, let's say, an experienced JV partner come to you with a brokered deal? Is there still potentially a play there, or is that a non-starter for you?
For me, I used to say, well, yeah, okay, we'll look at it, but now for me, it's a complete non-starter. It's a waste of time. Even if you can get through the whole, valuation and deal structures and educate the owner and all of that sort of stuff, you're probably still going to be overpaying for it. And if you're overpaying it, you're probably over leveraging yourself, which then creates a separate problem if you actually get the deal done. So I would far rather spend my time sourcing a direct to seller opportunity than cutting a corner and going to a broker, because I think on paper, look, this is quite a good deal. When in reality, it's not. Like, a lot of people come to us and say, well, I've got this broker deal, and they're asking for an LOI, so letter of intent, term sheet. So they'll go and get the financials. They'll then analyze the deal and see what they can come up with, and then they'll spend probably couple of hours typing up a really nice LOI, really selling themselves, selling the deal structure. But what they don't realize is all the broker is doing is they're sending this out to, everybody on their database that potentially could send an LOI in. And let's say they get 15 back from people, there'll be a range of valuations there. What they're then justifying to their client is their fees, because they've basically done a Dutch auction. They've gone out to market. They've, got loads of people that said that they're interested. They've got a load of LOIs on the table, maybe valuations ranging from, I don't know, 5 to 7 million. But what about those people behind those offers? Can they fund the deal? Have they considered everything in terms of lending? That these people probably won't be trade buyers. There'll be people that are either new to M&A or they've done a few deals. Maybe they've done leverage buyouts before. But then what they'll do is, once they've got those LOIs and whatever that highest offer is, they'll then possibly, if they're a proactive broker, and they won't always do this, they'll then go to the trade buyers, people that have got deep pockets, maybe private equity backed groups or public companies that are under pressure from their shareholders to make acquisitions. And they will then use these offers to drive an offer from a real player, if you like, in the market that's good for the money, that possibly will make a deal work on higher terms, because they're in it for the long game and they see the return and they see the synergies. But those sorts of buyers are probably going to change the name, cut the staff, cut the costs, automate, make things more efficient. Whilst there's nothing wrong with those things, from a business owner's perspective, they might care more about the legacy of what's going to happen with the people, the business, the name, the goodwill, everything that they've spent many years building up, for some corporate entity to come along. And okay, they might pay them a lot of money for it, but a business owner might see their legacy very much undone. And there's countless examples where that's happened. And whilst there's a market for that type of acquisition, because that's how the big boys play, from an SME point of view, I think the legacy can be sometimes underestimated as to how important that is. So yeah, you can go through the broker, you can write your LOIs, you can probably spend a year, looking at countless deals and writing lots and lots of LOIs. But in my experience, when that's the process, you don't stand a chance whatsoever of acquiring. So it's much better to spend that time sourcing. And that's time consuming in itself, but you've got more opportunity of finding somebody that hasn't already had their, I suppose, expectations, falsely set.
So you're quite selective with the JV partners that you actually work with now. In your opinion, what is it that makes a successful JV partner, and what are the sort of traits that you're looking for in a person if you are going to start working with them?
Yes, so really, as I've just said, it's about people that are prepared to take action. People that are prepared to follow the process. Some people follow it quicker than others, but from a standing start, it's probably going to take someone a year. The quickest we've ever done it is, I think, around about 4 months from working with somebody to actually getting that first deal completed. But I would say that that's unusual, and that was purely because they already had a relationship with a supplier and they saw an opportunity and they're able to leverage that supplier in order to get that deal done. So that trust and rapport building part of the process, if you like, had already been done. So yeah, somebody that's going to take action. And this is a long game. So, the people we work with can't be worried about paying the bills. If they've got a day job or, something else that's going on that's going to distract them from following this process. Yes, you can do it part-time. It doesn't have to be a full-time job, but the people that we work with that are the most successful probably are able to put, 15 to 20 hours a week into this. Most of that time is spent on conversations and meetings with business owners. And if you're partnering with us, we'll do all the other stuff like analysing the deal, presenting the offers with you, etc., etc. But you've got to have that initial conversation, and somebody that's going to be tenacious. You don't need to be an accountant, but you do need to be able to interpret a balance sheet. Should you really be buying a company if you don't understand the basics of finance? I'd probably argue no. Yes, you can employ great accounting experts that do, but if you're going to be the ultimate owner and negotiator of this deal, well, understanding how the numbers work, what a P&L is, what a balance sheet is, how we can use that balance sheet to fund a deal, debt service ratios. We will work with JV partners and educate them on all of those things, but you've got to have some sort of financial literacy. So really they're the core components. What makes it even more successful is if our JV partner already owns a business that they want to expand through M&A, because they already have potentially that platform that they can plug things in. So we're working with several people that already own very successful, profitable entities that they want to build through making tactical and strategic acquisitions. They don't have the M&A experience we do, and then by creating that partnership together, we've got more chance of executing a plan successfully than somebody that doesn't own a business. Have we done deals with people that don't own a business? Yes, absolutely. But you've just got to have those common traits. And where it works most successfully is when the individual we're working with has a particular sector experience, or maybe they've got contacts, maybe they're passionate about it. It's much easier to go and do a deal with a business owner if you talk the same language, you understand their business model, and then more importantly, once you've got the deal agreed and over the line, what levers to pull to make that business more successful, because you've got that expertise from something that you've done before, whether you've owned a business or worked in for another company. Having that experience is very critical if we're not working with a business owner, and somebody's coming to this new.
Okay, so if we're just to bring things to a close, I think one of the key things people probably want to understand is, can you do deals as a side hustle, or really is this something that's more of a full-time focus for somebody?
Yeah, in the main, yes, you can do this as a side hustle, but it needs to be a serious side hustle. So, if you've got an already successful business that, takes some of your time, or you have a day job, or you're a consultant, or whatever it is that you do, you need to be able to dedicate the time to this. So, can you do this evenings and weekends? Yes, because business owners probably are more comfortable with talking to you outside of office hours because of the confidential nature of things. So yes, you can fit this around, but the people that we find are most successful are the people that really do sort of treat this more of a full-time job around other interests. Probably more of their working week is spent talking to business owners, trying to do deals with them, than somebody that might do, 10 sourcing emails a week and maybe have one conversation with somebody. That's going to be, a much lower output than somebody that spends 15 hours a week, talking to business owners, having meetings, making sure sourcing is being done. If you consistently do that week in, week out, and you're approaching the right financial profile businesses, then within 6 months you should have a deal agreed. So you get out of it really what you put in.
Okay, so any words of summary as we wrap there?
So yeah, I would say, look for those direct to seller opportunities, work with an experienced partner that understands M&A and the pitfalls and on all of the things that we've spoken about today, going after the right size business that comes with a capable management team, and making sure that the process is followed. It's about sales, it's about marketing, it's about, financial literacy, it's about tenacity, and it's about negotiation. And if you put all of those things together, then you should get the right outcome, which is generally 10x if you're working with somebody that's already got that experience.
Okay, perfect.
Great.
Can I ask you a favour? If you like this content, then please do subscribe to the channel to receive more content like this as we upload it. It helps our channel and shares the message with like-minded deal makers. It also helps me to connect with our audience and bring you more content that you can watch.